This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's guest features an expert in financial services and capital markets who has experience as both a strategic investor and a VC. We welcome Rana Yared, a general partner at Balderton, where she co-leads their growth fund. She came to Balderton in 2020 from across the pond, where she was a partner at Goldman Sachs, first in the Principal Strategic Investments Group in both New York and London, a balance sheet investing team, and later in GS Growth, when the group became part of the GS Growth efforts that began to take in outside LP capital. At Goldman, Rana oversaw investments in financial technology and enterprise technology companies, as well as the commercialization of Goldman's technology assets in both New York and London. She represented Goldman on the boards of Tradeweb, NAV, Vestwell, New York Shipping Exchange, and SwapClear at LCH. She currently serves on the board of Tradeweb in an independent capacity. Coming off a fundraise of $1.3 billion in new capital across early and growth stage funds at Balderton, Rana and I discussed what LPs were interested in and why Europe is a compelling investment ecosystem. We had a fascinating discussion about revolutionary and evolutionary innovations in financial services and private markets, including the likes of iCapital, Tradeweb, and Revolut, why global tech companies can be built in Europe with Revolut, a Balderton portfolio company, as a prime example, why London and Europe are compelling fintech and financial services ecosystems, how LPs should look at the European investment opportunity, differences and benefits and drawbacks of being a strategic or permanent capital investor versus being an independent VC fund, and the importance of being a risk manager in venture. Thanks, Rana, for coming on the show to share your wisdom and views on Europe, venture, and private markets. We hope you enjoy.
We're going mainstream.
Rana, great to see you. Welcome to the Alt Goes Mainstream podcast.
Thank you so much for having me. It's a pleasure to be with you, Michael.
Likewise, it always is. So much to talk about. I think your background as an investor, both in capital markets, in alts, and Europe, moving from the US back to Europe. There's so much to talk about across all aspects of kind of private markets VC. Tell us about your background. How did you end up as an investor and ultimately now as a VC at Balderton?
I spent 14 years at Goldman. I was a partner there when I left in 2020. I joined Balderton Capital in Europe, in London in 2020. Like all good Goldmanites, I'm classically trained in investment banking. So I spent 2 years in banking, and in the old days, because now I'm old, at GS, it used to be the case that after your second year, you were kicked out of your team to go on rotation. So you get the posting, and my team, which was called Principal Strategic Investing at the time, now Goldman Sachs Growth, had a third-year analyst posting. And a mentor of mine, a woman called Michelle Pingera here in London, said to me, I think you're better suited for investing than continuing in investment banking. And I said to her, why? And she said, well, you have a little bit of an insubordinate streak. It's like, okay, it's good. Which is true. The hierarchy of investment banking, when I really thought about it, wasn't for me. And so I turned down a job in Chicago and a job in San Francisco. And I took a 1-year investing seat in London. And that 1 year turned into 5 years in London and another 11 years investing at GS, ultimately split between New York and London. And when I had the team split, looking after both sides of the ocean, I increasingly had the view that I wanted to spend more time in Europe. The opportunities had become just as good as they were in the US with respect to the size of company that you could build, but there were actually fewer quality dollars, meaning quality investors who are actually chasing those great investments. And so as far back as I think 2017 or 18, I was on the FT podcast and I took the view, I just want to be spending more time here. So when the opportunity came from Balderton, which runs an equal partnership and to be an equal partner in ownership, in economics, in carry, and vote, it was just too good to pass up. So our family moved from the US back to the UK, where we are now.
I want to get to all the details around your views on Europe and why it's such an interesting startup ecosystem. I think there's a lot there. But before that, I want to rewind the tape a little bit because the work you did at Goldman is so pertinent to a lot of what's happening in private markets. You have a number of really interesting vantage points. You're on the board of Tradeweb, which we could compare to some companies in the alt space in terms of thinking about market structure evolution. But what was it like in the early days of what was PSI? Because now a lot of us PSIers have gone on to invest in private markets infrastructure. And you did it at Goldman as well, iCapital, Simon, both of which have become big companies in this space. What was it like in the early days of PSI and how did you approach market structure investing?
You've just revealed to the world you had the misfortune of working with me at Goldman. Very sorry for anything that you went through in those years.
Sitting next to you too.
Sitting next to me too, it's true. I think the vantage point from GS was invaluable because it gave me a practitioner's view as an investor. People say in VC land, you're either an investor or an operator. Which one are you? Doing the job at GS actually made me both because I got to see how the operations worked. And I was held to account as I got more senior like an operator. So for my own risk management, for how I did exits, for my operations working well, for my hiring, my firing, my everything. Specifically on capital markets, where it ended up being really valuable now when I'm broader in venture capital, is that there's some real particularities about moving highly concentrated, highly regulated markets with very meaningful incumbents off the systems and processes that they are used to and onto modernity. And I got a very clear view of that. And a lot of the lessons that I learned in financial services, I now know are applicable in healthcare, in large industrials. And so there's a paradigm. And it was credibility building to be able to say to people, actually, I've seen this movie play before. I understand your pain. Here are some of the lessons that have been learned in the past. And I think the last lesson that I would highlight is that having that vantage point on major market structure changes also reminds you that nothing is sacred in terms of the way it's done. I sometimes get the answer, well, it's done this way because it's always been done this way, or you can't disrupt this industry because it's always been done this way. But gosh, if you can disrupt the big banks, then you can pretty much disrupt anything.
It's a really interesting point, particularly as it relates to financial services. At Balderton, you've obviously invested in some very disruptive financial services companies. Revolut comes to mind as one.
Yeah.
How much do you think that change, particularly in financial services and even some of the other industries you're investing in, is truly disruptive or revolutionary versus more evolutionary change, having worked at a bank where still a firm like Goldman Sachs ends up being both innovative, but also making it hard for disruptors to truly disrupt?
I think we have seen some really revolutionary companies in financial services. So you've name-checked Revolut. I will put them top of my list. I think Nikolai and Vlad have built a generational company, and they have brought non-financial services development speed and mindset to financial services while respecting the regulatory environment of financial services. So they develop as fast as the outside world while operating inside of the constraints of financial services. And that is actually revolutionary because of what you've just said about big incumbents. A company that you're very familiar with, you've actually had the CEO on the podcast here. I think iCapital is revolutionary. If you ask me why, I would say because the idea of a lot of these big wealth advisors, think of the thundering herd at Merrill, the Dean Witter crowd at Morgan Stanley, giving up the creation of product and the management of product to someone else, I think 10 years ago was completely unheard of. What they've managed to do at iCapital is convince a whole bunch of relationship managers that what they're great at is relationship managing. So they should do that, and everything else should be commoditized and managed by someone who's a tech specialist. For all these institutions, there had been a mindset of if it's not built here, it's not good enough. So shifting that mindset, in my view, isn't an incremental evolution. It's actually a revolution that can only happen if the underlying technology is amazing. And I know I've just given Lawrence the best advertisement ever, but it's from the bottom of my heart.
I was early at iCapital and I'm still involved as an investor, so I don't disagree. What I would say to put a finer point on that is you provide two very different examples. Revolut is truly going against traditional financial services, whereas iCapital brought traditional financial services in and under the tent by getting banks like Goldman to be investors and customers, many other banks, many other private equity firms on the GP side as well. So it's interesting to think about the kind of change in an industry by either trying to truly out and out disrupt like a Revolut versus doing what iCapital did by bringing everybody in the industry into the fold. Tradeweb's another great example of that, where you're on the board as investor at Goldman, you're an independent now. Given your background at Goldman, do you have a view that it's harder to truly disrupt, or it's actually necessary having worked inside a bigger financial institution?
I think both. It's both extremely difficult to truly disrupt, and it's extremely necessary. It's both necessary for the clients of those institutions, whether it's the individual with a current account or whether it's the gigantic hedge fund and asset manager or the pension fund, but it's also necessary for the institution itself. I think what has allowed the Goldman Sachs, the Morgan Stanleys, the JP Morgans of this world to remain excellent is that the world was changing around them and they were able to adapt to that change. So I think the answer is both.
Do you think that in financial services, it is important to find ways to partner with existing incumbents because they have such a stranglehold on an industry in many ways? Or is it better to try to go at it on your own as a founder?
It depends on who your clients are. So for, let's say, the two examples you gave, which are the iCapital and Tradeweb, we can also name check Simon here. You can name check the origins of the Intercontinental Exchange here. The clients there were extremely large institutions and corporates, which together would be called institutional investors or institutional actors. And there, I think it is better to partner, because if you need to change behavior of your own client and how they act to their clients, then you need to partner with them to make them feel like that change in behavior doesn't disintermediate them from their client. So that's the comment I made about you let the relationship managers manage in the iCapital example. They didn't lose that connectivity with the individual, but they gave up the hassle, frankly, and the cost of having to run individual tech stacks. For something like a Revolut or a Monzo or a new bank in Latin America, they are convincing you and me, individuals, that there's a service that they're providing that is superior to that of the incumbent banks. And I think in that case, they actually don't need the cooperation of the incumbent bank to convince me that that is superior. And so there's actually no point in partnering.
When you take those two different types of examples or phenotypes of companies, what do you think are the skill sets in founders that make those types of companies, and maybe different skill sets given that they're different types of businesses to build within financial services, make them successful?
The one commonality is you really have to have durability for the long road. Why? Because in the archetype, which is big concentrated clients, The revenue will come in big concentrated chunks. The sales cycles are long. The doubt is high. So you really have to have the ability to weather that. I'm sure their investors will nag you about the revenue profile for a long time. And if you don't have that durability, you're going to veer the course. You're actually potentially going to throw out the baby with the bathwater and stop the company before it should. If you look at the evolution of the Tradeweb revenue, which was shared in the S1, it took a long time to get to as big as it did when it went public, but the multiplication of the revenue has accelerated since 2013 in particular. You need that durability on the consumer side because it's hand-to-hand combat. You have to acquire every single client individually. You pay up in CAC to do it. Your neighbor, the next startup, can acquire them and you've got to pay to get them back. So you really have to have the durability to go through that hand-to-hand combat. And also, I would say, exceptional vision in product design to constantly have new product velocity to keep from losing your client to the person next door. And as I said, I think that's what really makes Revolut generational, which is that their product velocity has just been extraordinary.
You mentioned two really interesting things that are almost a juxtaposition. One is durability, which I extrapolate to mean some level of patience. And the other is speed of product velocity and shipping great product, particularly on the consumer side.
Yeah.
Do you think that working in financial services and seeing the inner workings of how institutional financial services works at Goldman and then investing in all sorts of companies, consumer enterprise, has that made you a more patient investor?
Yes. Yeah.
How?
In two ways. One, when I first meet the companies and they show me their business model and they're like, I'm going to acquire X number of institutional clients in Y number of months, I just say to them, no, and you don't have to, because I know that they're not. So I'm more patient in the opening moments. That actually takes the tension out of the room. And then we start really talking about, the sales cycle is really hard. Like I had 17 meetings that fill in the large institution of choice. I'm still not sure I got to the right person. How do I know? It just kind of sets us in a relationship of trust where the company starts to share a little bit more about its real challenges. And by the way, that helps me figure out if the company really understands and has product market fit, but it then builds trust from the CEO to me. So that's the first way I'm more patient. I think the second way I'm more patient is that you miss a quarter on these big chunky things, because the reality is that a $10 million deal signed in March versus April, you still have the $10 million deal. What you can't do is get sloppy and let March become September. But the small slippages, which in traditional SaaS, or let's say SaaS-based financial services, speaks to the health of your sales cycle and the repeatability of your product sales cycle, doesn't hold when you've got these really big, chunky contracts. And so I'm definitely more patient. And I'm definitely kind of more aware, I would say, of what is a real hair on fire problem and what is just natural for the client base that you're serving.
I think you're hitting on a few things in that answer that bring up another really interesting question, which is you've had the vantage point of working at a strategic investment firm that's able to leverage a bank and leverage a bank's balance sheet. And also as a VC at one of the largest firms, you just raised over $1.5 billion across early and growth stage fund. Congratulations, by the way, at the most recent raise for Balderton. What do you think some of the pros and cons are of investing as a strategic investor off a bank's balance sheet that you did at Goldman versus being a VC at Balderton?
I will say the greatest pro of investing off the balance sheet is discipline. Balance sheet is finite by its definition. In order to get more allocation, therefore more dollars to spend companies, we have to demonstrate that we can return cash. Many inches have been spent on the ills of venture capital's inability to return cash to its investors. This mindset has no problem at Goldman, or at least it didn't when we were investing off the balance sheet. The downside of investing off the balance sheet is that sometimes either the companies or your masters think that you care about yourself more than them. We had to do a lot of convincing of portfolio companies when we made the investment that Goldman was off the balance sheet, but was a for-profit driven investing enterprise. How did they do that? We were our own profit center. It wasn't some kind of central corporate slush fund where investments were basically made in the hopes of garnering some kind of strategic advantage. We also have to remind our masters of this, masters being management of Goldman, because inevitably when you make financial services investments and you're a financial services firm, you end up being a user or a competitor of some of these investments. And someone somewhere will be like, hey, can you make the call to make X happen? And the answer is no, I cannot. Why? Because that's not in the best interest of the company, and we have to act in the best interest of the company. So that's the very natural tension that happens when you're on the balance sheet. That obviously does not exist when you're sitting in a standalone venture capital firm.
What was the biggest learning that you've taken from being at a strategic investment firm to being a VC?
I think I'm going to have to answer the question the way I just did, which is it's the discipline. And I don't think actually that is largely applicable to all strategic investing. I think very particularly the education that was received at GS equipped me with that discipline. I have it when I think about portfolio construction. I'm a risk manager at heart. I obsess about how we're going to exit things because I'm a risk manager at heart. And I also don't pay a lot of attention to noise. Noise is both the hype cycle and the fake we're in the doldrums. This concept of investing through the noise comes from 12 years on the trading floor because you can't lose your head in that environment. So that overarching sense of calm that I try to maintain, I think is a legacy of 14 years very well spent at GS.
And now you've decided to move from the US to Europe. I'm sure that turned a lot of heads. It was an interesting time to move to Europe in terms of the venture ecosystem.
Yeah.
And you are, like you said, a risk manager, and having sat next to you, incredibly thoughtful about the decisions that you decide to make. What made you decide to go to Europe and invest in the European ecosystem?
I had spent increasingly more time in Europe when I had the two teams. And the Balderton opportunity was just immense. I'm not sure, actually, absent that opportunity, I would have said, today's the day I'm getting up and moving myself to Europe, totally fairly. I probably, absent that, would still be sitting at 200 West and doing whatever whoever has told me to do. But because the opportunity came calling, and because I already had that view that there was something special starting to happen in the ecosystem here, it made it really clear for me that I had to make that move. And those special things were the first generations of successes had sold out. You now had that money being plowed back into the various national ecosystems, whether it's in Stockholm or London or in France. Brexit, for whatever one might think about it, actually dispersed startup opportunity across Europe. That's actually positive because it gave access to a broader employee base as opposed to concentrating all of the startup opportunities into London, or a very significant portion of the startup opportunities into London. And so I assessed that there were a lot of really positive things happening, but one of the negative things that was still true in Europe, and I have to say to some extent is still true 4 years on, is we lack local in-between capital. And what do I mean by in-between? We have storied private equity firms here. EQT comes to mind, HG comes to mind. And we have amazing venture capital firms, of which I'll put ourselves an index in that bucket, which have been around we're in our third decade. But we still don't have the correct amount of capital to fund all of our own internal European opportunities resident here in Europe. And so I assess that as a real differentiator when Balderton decided that they wanted to add their growth fund. And as I said, a partner was retiring, and that gave me the chance to be brought on as an equal owner and partner.
From a data-driven perspective, what were some of the things that you convinced both yourself and then ultimately, as you raised first fund, now next fund on the growth side, convinced allocators to say, you know what, there is a real dearth of capital in that gap between early stage and private equity that you could fill?
Going back as far as 2019, we started to see that the 5-year IRRs in Europe were actually higher than the ones in the US. When we went on the road this last time, indeed, the same thing. It's the 5 and the 10-year are higher. That's partly a function of entry price and partly a function of number of opportunities.
And also, I think I've seen this more from the early stage side, but I think this would probably be true on the growth stage side as well. European companies tend to be more efficient. I think it takes half the amount of capital for most unicorns in Europe to be minted relative to the US. There's obviously more nuances to that, as well as maybe outcomes are not necessarily the same. Although look at Revolut, look at Spotify, look at Klarna. I'm missing a lot of others, but now I think you can probably say there's big enough outcomes to be created in Europe where if that holds true, that there's less capital that needs to be deployed because European founders tend to be more efficient, there's going to be better returns. Is that something that you think is still going to continue to persist? Or is that going to be harder as more US firms start to open up offices or spend time on the ground as we're starting to see that happen as well?
No, I think it's cultural. And you can answer back, yes, but there are many cultures in Europe. I think it's cultural. And the reason for that is, in addition to the stat that you gave, it's also cheaper to get to 100 million of revenue. It is cheaper to hire talent here because of the dispersion, because you don't have that high concentration in a single place and everyone bidding the same talent, therefore bidding up their OpEx. We're actually keeping costs lower, so that's positive. Remember, Europe generates 1/3 of the world's engineers also, without 1/3 of the population of the world. So there's really a competitive advantage here on the engineering side. And I think that's going to persist. And even, as you said, with the entries of the US firms, I think that persists for two reasons. One, the greatest compliment you can give Europe is to have the US firms thinking that they need to open firms like offices here. That basically is a sign of success. And my partner Daniel says he used to envy his colleagues in San Francisco for the opportunities that they had, but now they're coming to find his opportunities. So that says something. Second thing is that dispersion doesn't change because American firms have arrived. Yes, many of us are domiciled here in London, but the companies are not. So you don't get that New York City, Silicon Valley, everything is bid up factor in the same way that you do, simply because of the dispersion we have.
At growth stage, do you believe that you can invest in and underwrite European companies that can become massive businesses just in Europe rather than have to go elsewhere to expand their TAM, build a bigger business?
Yeah, it depends on the sector, but yes. I hate to come back to it because we've said a lot about Revolut already, but Revolut has not so much as put its pinky finger yet, really thoroughly outside of Europe. And it's a huge business. And actually, that's what makes Revolut so exciting, is that when you read the released public financials, you realize that there's still so much ground to cover just by geographic expansions into other markets. That's one example. Not to use another fintech example, but Trade Republic and Scalable are very big businesses. Obviously, Scalable is an investment of ours. They're never going to forgive me for breathing their competitor in the same sentence, but I think the fact that there's two is actually more powerful than there being one.
And really only Germany.
Yeah, and they're both really only in Germany, so they have not commenced the true expansion of their product across Europe either. And in the same way that Schwab and Fidelity and TD Ameritrade can all coexist and be great businesses, it's a good sign that Europe can support multiples of these.
What do you think are some of the unique features of the European ecosystem or founders that actually might give European companies an advantage in building really big businesses?
You have to go international right away, basically, because people think of Europe as a monolith. But if you're a German company and you're going to expand to France, that's actually going international, whether it's because you have to deal with a different set of laws, whether it's cultural, whether it's the types of clients you're selling to on the SaaS side, like the protocol of the sale, if I can call it that. And so because you learn to go international very young in your life, you're actually very nimble. I think that's an advantage. European companies are generally less daunted about the next expansion than, let's say, an American portfolio company of mine in the old days would think about, like, oh my goodness, I have to expand to Europe. It was this cataclysmic moment in their lives. It's just something that has to happen for European companies.
How do you think that fact makes it different for you as an investor?
I have to do less convincing about future-proofing your business. I think founders who know that they have to expand, that they'll have many competitors, that they're going to have to be nimble, start to future-proof earlier. The gift of the US is its size. That's the honest answer. That's why it's created more huge companies.
Does it also make it more challenging as an investor if you have to figure out how to cover these markets properly across Europe, either in terms of having great relationships with earlier stage investors at the growth stage fund, or the early stage fund that you have, people know about Balderton because of its brand, or making sure you have people on the ground? How do you think about that from a a business and brand perspective when it comes to deal sourcing across Europe?
So venture and early growth, by that I mean growth done by venture firms versus growth done by private equity firms, is a shoe leather business in Europe. You must go to the companies. So, we have a presence in DACH, we have a presence in France, in the Nordics. We have people who speak Italian and French and Spanish and Portuguese and Swedish and Finnish, and you have to. You just have to. There is this sense of the VC goes to wherever the great company is here in Europe. I pivot that to my time in the US. Companies go to Sand Hill Road, they go to University Avenue, and they go to Union Square. And the GS office was one train stop from Union Square, so I got the visit, basically. It's a very, very different relationship between who goes to whom, again, because of dispersion.
Will that ever change in Europe?
Never say never, but in some respect, I hope it doesn't. I hope it doesn't because we have a lot of individual centers that have the capability to grow huge companies. I think that's really great. Having a portfolio company in Belgium is not something that most people expect, but I'm guessing that almost every major VC firm has one in Belgium. This is good. It grows a lot of ecosystems. It gives a lot of talent access. And so I almost hope it doesn't. It also keeps the VC humble, if I could call it that. Like, it's not all about us. It should never be all about us. Going to the founder is a great reminder that it's about them.
How do you think all the commentary that you just shared is either impacted by or changes as more US VCs come to Europe? Because maybe they, to your point, have been used to being the ones visited by the entrepreneurs. Do they have to really think about doing things very differently if they want to do Europe well?
I think they must. I don't know what goes on in the interworkings of any firm other than my own, but I think they must. And with one exception, most US VCs haven't really put heft on the ground here in Europe. It's 1-2 people. So you're not going to change the culture with 1 or 2 people.
You really have to spend time and invest. And I guess from that perspective as well, you've obviously solved a little bit of this by creating a growth fund to kind of be the missing link between early stage and private equity. What do you think is still missing from the European ecosystem that, if it were to be added, would take it to the next level?
It's actually talent expertise. So by virtue of being, let's say, a generation behind, so 10 to 15 years behind the evolution of the US ecosystem, what that means is that you have fewer people who have been CMOs of a public company, CROs of a public company, have taken a company public as CFO. And so just necessarily by where we are in the cycle, fewer people who have already done it at each major position. And once I think the next big cycle of exits happen, those people will take a break, I'm guessing, to relieve themselves of many years of stress. But then they're going to go back into the market in one way or another, either as advisors giving guidance or maybe for another role because they want to try just once more. When that happens, you're going to have a real influx of critical mass. And I think that is one of the big unlocks that the next step of the European ecosystem needs. And it's not one that you can, quote, do anything to unlock other than continue to nurture great companies that get themselves to that point so that you have people who have that experience.
What do you think are the ways in which you can help upskill talent as well? Is it connect them with people who've done it in the past and build the bridges with more mature ecosystems? Or is it something else that you can do? Because I think what you said is such an important point too, that you have to tropicalize things for the region. And there are certain things that are very different about Europe. So having a US CRO or CMO provide advice to a European counterpart may not actually, maybe at a high level, but at the nuts and bolts of it may not actually be as valuable because there are so much differences in the European market structure.
We provide a mentorship program, if I can call it that, through our executives in residence. These are experts who have had the big role before. We have Dave Kellogg, who writes the Kell blog, is our CMO expert. He has both obviously done that role and been a CEO, but his specialty is go-to-market, and he's a mentor to the CMOs in our portfolio. He was very purposefully selected because his role was global. He had oversight over Europe and US. He understands how the two ecosystems are different and how they are the same. We had the great pleasure of having the former CPO of Booking.com, which is, I would say, a generational European company in consumer and travel, as an EIR for us, also providing that kind of guidance on the product side. The product side is less about that regionalization and more about the how do I scale and address the next phase of what I put to my clients, basically. How do I do it in a way that's sensible from a tech stack point of view, et cetera. And we also have a very experienced CTO who does the same. Multiple companies, very senior CTO in several firms across multiple industry, giving guidance around architecture, how you should think about that. So that's one way. The other way is, as you said, we have, and we're very lucky to have, because we've been around for 25 years, a really deep network. And we connect to that network our current portfolio. A couple weeks ago, email from one of our fintech portfolio companies to CEO, founder, exited in the old GS days. I'd love to pair you all to know each other. Is this possible? Of course, the answer is yes. You have to provide that mentorship coaching opportunity where you bring in the know-how without that know-how assuming that just copying what you did in the US is what's going to work in Europe.
I want to take the theme of what you just discussed, mentorship and helping certain people learn, to the LP side. What can LPs who are newer to the European opportunity learn from existing allocators to the European venture opportunity?
That it's worth allocating to. We already went through all the
Yep.
stats on returns, and it's cheaper to get bigger faster. There was a generation of LPs who thought, I'll get my episodic European exposure through my American managers. And then there was a cohort of LPs who thought, no, if I want European exposure, I should be in a European manager. So more are coming over into bucket two, I'm very pleased to say, as the European opportunity grows. So it's like becoming easier to convince people of the fact that there is a standalone opportunity in Europe that needs to be covered locally.
Part of the subtext of that question was, how do US LPs or international LPs understand the European opportunity? But the other part of the subtext of that question was, how do European institutions, you look at endowments, I know that's a big conversation in the UK in particular right now. You look at US university endowments, allocation to venture is significantly higher than UK university endowments, allocation to venture. And obviously there's a number of structural reasons why, but how does the European LP start to take more advantage of the European investment opportunity into venture and growth?
I would say most of that is out of the hands of venture. On the pension side, let's say here in the UK, there are rules around what managers you can pick if you're the pension based on the fees that they charge, and that rules out a lot of private assets and puts a lot of the pensions into public market assets. Unfortunately, by the last time I looked, the UK pensioner is the poorest in the OECD as a result of having not benefited from that growth, frankly. I can do many things. Changing policy is not one of them. And so I leave that in the good hands of the professionals like there. So that's kind of the first set. The other thing you mentioned, university endowment, the spirit of university philanthropy is very different in Europe versus in the US. Very different. The reason for the smaller endowments is not that Cambridge and Oxford have proposed less successful people than Harvard. It's actually because they're government institutions, it has not historically been the case that they have the amount of philanthropy that private American universities have. And so I would say that they, for a long time, really didn't have the opportunity to make investments in venture or in private equity for that matter. Now you see that changing. The big universities in Europe, they look to the example of the US, and their endowments look more and more like those in the US. The issue is that there isn't that many of them.
I want to double click on the first point you made, which is around the pensions not being able to allocate to funds. I think it's a really interesting point because we are seeing a lot of product innovation within private markets. Sure, this is coming from the large alternative asset managers, and there's business imperatives as to why. As an example, evergreen fund structures to enable other investors. Like you mentioned, firms like iCapital are enabling that to happen through the infrastructure. But is there an opportunity there too, despite all the challenges that you cite, is there an opportunity there for product innovation to happen amongst the venture managers where maybe they could create a different fund structure or product structure that has different types of fees associated with it? Sure, obviously you have to think about that. But as you think about the evolution of the business of something like Balderton, you're in the billions of AUM. I'm sure you're starting to think about some of those things as part of a broader trend and alternative. So I bring up that question in the context of that backdrop.
There's always opportunity for that innovation. We spend time thinking about it. We have not made a conclusion one way or another. One of the, I would say, unfortunate aspects of the fund structure generally is that we have a term limited fund on long duration assets. You asked me at the very beginning, what's one of the benefits of investing on balance sheet? It's evergreen. That's a real challenge. It's a challenge for fund life. It's a challenge for how we think about making the right decisions at the right moment. And I think it also could potentially be how we unlock the knot, which is pension.
It's a really interesting point because, and I'm making a generalization here, but many European businesses, maybe not necessarily venture-backed ones, but there's great history and tradition of family-owned and family-run businesses that generally want probably very long duration or permanent evergreen capital as their capital provider because they don't want to have to change hands over time. Is that something that you would think about in Europe, given the origins and history of a lot of its business creations?
We functionally now have the ability to create vehicles or follow-on vehicles that create permanent capital. So that's what I meant by we did a lot of thinking about how to both live within the fund cycle that is necessary for some sets of LPs, as well as meet the demands of what the companies actually need and potentially start to innovate. Again, we have no conclusion yet on how, on meeting the needs of as yet unknown, untapped LPs who have a different imperative than the time bound of the traditional VC fund. I think this is unfortunately like a Gordian knot because part of the knot is the regulation.
Do you think, given the success of European venture, and one of the differentiators, honestly, is governmental participation in venture? Obviously, that varies by country.
Yeah.
But has that made regulators take notice of how important technology innovation is to Europe and how important the venture ecosystem is to Europe?
I think in 2024, you have the various governments duking it out to make themselves as attractive as possible for venture to happen in their respective ecosystem, because there's a general view that it's critically important for the employee base, it's important for innovation across the country, and it's what keeps Europe competitive. And I think philosophically, Europe as a whole is extremely concerned in 2024 about how to be independently competitive from the United States.
So on that point, what makes you most excited about European venture going forward?
The opportunities are in every sector, and you can now make big companies in Europe. So it used to be you founded a company in Europe, and to make it great and big, you had to move it to the US. This is the history of my own partner, Bernard, who founded Business Objects. But today you don't have to. You may move your sales teams there. You may have the CEO move because that's the right thing to do. But you don't have to move engineering and sales and the senior leadership lock, stock, and barrel out of Europe and into the US to have a great and valuable and global business. And that's the thing that really excites me.
Taking that one layer deeper, are there certain industries or categories that excite you most right now?
I'm always going to answer fintech, always. And the reason why I'm always going to answer that is because the spend in financial services is huge. Both the internal budgets for staff that lives inside those organizations and what they spend on vendors. Whether it's in fund accounting, whether it's in clearing and custody, futures risk management. You have huge companies that can be built. By huge, I mean like tens of billions of dollars that can be built by finding efficiency that is to date unfound in insurance and asset management and hedge funds and in the big banks. And so the size of the opportunity is just huge.
What do you think are some of the unique advantages that Europe has when it comes to financial services?
I think we have two here in Europe. One is risk management. A lot of the really big market structure infrastructure is here in Europe. One of the biggest centers of risk management is London, the London Clearing House, which is owned by London Stock Exchange Group, obviously Deutsche Börse and the DB1 Group in Germany. So there's this huge history of managing global interest rate risk and global FX risk out of Europe, predominantly out of London. And if you're going to convince systemically critical companies like banks to give up critical functions to startups, then there has to be like a baseline understanding of that risk management. So I do think that's a really big deal. And then the second one is I think this is a fantastic regulatory environment.
So you mentioned some of the positives. You also studied international relations. What worries you, and maybe that's a little bit of a leading question for Europe, given what's going on geopolitically, what worries you most about Europe right now from a investing perspective?
I mean, I'll pause the Ukraine Russia crisis and the Israel Gaza crisis, because these are existential in a way that cannot be solved by many people. What worries me about Europe is that the individual desires of countries to be attractive, which is wonderful. We talked about the positives that come out of that, could lead to the negatives of becoming siloed and being unwelcoming to companies or investors from other European countries. So that's kind of the positive as it turns negative. If it's taken to an extreme, you go from openness and competition that leads to efficiency to competition that leads to closure. You want to make sure that you stop at the efficiency versus the closure.
Interesting. I think you have a fascinating vantage point on all of this. And I want to switch gears by asking you, I think this is a fascinating concept and also fascinating that you just wanted to do this, but how has your background in war studies helped you as an investor?
I think it's helped as a negotiator, actually. You have to know which hill is going to be the hill that you're just going to stomp your feet on. One of the great lessons that goes from Sun Tzu to Clausewitz is that you can't fight every battle. And more importantly, if you fight every battle, you're going to lose the war because you're going to expend your energy in the wrong places. So this concept of expending your energy in the right place is probably the most useful lesson that I've taken from war studies into GS and now into VC investing.
It's a really interesting point around investing. So much of it's about time. Time is one of your most valuable assets. So making sure you figure out where to spend your time is important. On that note, I ask this question to everyone. I've looked back generally and asked people what their most favorite or interesting alternative investment has been. But given that the world is in such an interesting spot from an investment perspective in a number of ways going forward, I want to ask that question in this context of what is your favorite or most interesting alternative investment looking forward?
I'm still incredibly excited about one of my old portfolio companies, Vestwell, which is changing retirement and really offering small plan retirement options in the US. And so as a result, my forward looking is what's going to happen in Germany. So German retirement investment rules change in January. It will allow people to privately manage their retirement for the first time as opposed to needing to go through insurance companies. I think this is a radical shift in the management and creation of wealth widely here in Europe. And so I'm pretty excited about what that change is going to mean. I mean, we are not even in the first inning. We're before implementation and rulemaking, but the promise that this can have, I think, is really meaningful.
On that point, do you think European investors are going to think about investing differently? Because you mentioned when it comes to retirement, a lot of times in Europe, people have been seen as savers. That's now changing with the likes of Revolut, Trade Republic, Scalable, as you mentioned. How does this all change going forward?
So I don't think we should put saver and investor at opposite ends of a barbell. So if you had the guys from Scalable on, they would say that we are the place where you save and build your wealth. So the two go together. Hopefully I got their slogan right there. And so I think what's going to happen, starting hopefully with this change in the German pension rules, is this concept of you are both the custodian and the manager of your wealth. And that's super important. And we don't even know all the ways that change is going to trickle through in market structure, but I know enough to know that moving that pot of assets from the dominion of insurance funds into a broader set of options is going to have rippling effects, many of which we have not even conceived yet, frankly.
That's fascinating. And I think such a fascinating thing to keep an eye on. And I think also a great theme to end this podcast on and tie it with a bow, because you talked about patience early on in this podcast. That's what investing, particularly in private markets, is. You have to be patient. You were patient about investing, figuring out how to invest in Europe. You've invested in a number of companies, whether it's the Vestwells, iCapitals of the world at GS, to Scalable and others today at Balderton. the concept of patience. I had to be patient working with you because I had to keep up with you and your photographic memory, which was incredibly hard to do. I'm still trying to keep up. But I think that's such an important concept of patience. We've now known each other for 12 years and look at what's happened in that time. iCapital hadn't even existed when we knew each other.
Correct.
So I think that's such a fascinating concept. And I'm really curious to see over the next decade what you do in Europe.
Thank you. Oh, I'm really excited to be doing it, whatever it is. I'm super grateful for you having me on this podcast. It's a joy to join you. And it's so fun to continue our 12-year relationship here.
Another decade plus at least.
Here we go.
Awesome. Thanks so much, Rana, for coming on the podcast. Really enjoyed it.
It's been a pleasure.
Pleasure to have you.
Bye, Michael.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going